All right, guys, good morning. And I want to complete on what we started on consolidation. So far, we've done consolidated financial statement of financial position with subsidiary. And we've also done consolidated statement of profit or loss, also with subsidiary. There is a part of it which concerns the associate I want to quickly look at in this very short time. Now, I want to use this portion of this table to describe investment in associates. All right. So here I'm going to do some explanations for you. Now, when we say an associate, all that we mean is that it is an entity over which or in which an investor has what we call significant influence. As significant influence. All right. And as such, that associate is not a subsidiary. Okay. It's not a subsidiary, nor what a joint venture of the investor. Okay. All right. So that is an associate. Okay. That is an associate. Now, when we say significant influence here, what do we mean? Significant influence, we mean, and it's always evident by the representation on the board of directors, because that is where decisions are made. And as such, you participate in policy decision making. Okay, so you are there, even in terms of the ownership, you are there, and your voting power is also probably up to 50%. All right, so so this is what we are saying. If you have significant influence, then it means that, number one, your representation in the board of directors allows you to participate in decision making. Okay, so that is it. In the BOD, okay, allows, this case, we say the investor to do what? To participate in policy decisions, so that at that point you are capable of affecting policy. Number two, what we also say is that if you have between what, 20 to what, 50% voting power, it means you have what? Significant influence. All right, that is it. That is it. Unless it is demonstrated that is not the case. But if you have 20 to 50%, then it means that you have a significant influence. All right, significant influence. Normally we say like less than 20% does not actually give you significant. So if you have influence, then this is you have a voting right of such. Now, in terms of doing Conso where there is an associate, there are certain things that you need to do. So you have something like, so let me call it the accounting treatment for associates. Now, the first thing you need to do is to remove the non-current investment in the parent's book relating to the associate. So that one doesn't form part of the consolidation. You just have to remove the investment of the parent, whatever investment that they've done inside the associate, you have to remove it. Okay. So we say that number one, remove the non-current investment non-current investment from the parent's books. So that thing that is stated in the books, like investment in associate, you need to take it off. All right. So that is what you do. But you will have to replace it with doing your own workings. All right. You will have to now calculate the investments in the associate, just as you do for the subsidiaries. You will now have to calculate your own investment in the associate. Okay. And that is what you will include in the financial statement. All right. And that thing you are going to do is going to introduce us to a new workings, because we need to work this. And the workings that we are going to use is what I call what? Working 6. So we are going to do working 6, all right, somewhere here. Okay. Because when associate comes in, you don't add them line by line like the way you do. You take the parent NCA, then you take the subsidiary NCA, then you add. In associate, you don't add them line by line. Okay. So we say that do not add line by line for associates figures. Don't do that. The way when we are doing the P&L, if it is media, let's say we say 6/12, we multiply it and add it to the parents own and put it the final figure. But here you don't do all this. You don't do that. All you need to do is to calculate your investment in the associate. Okay, so that is all that is all that you need. All right. So that is it. So because of that, this thing is going to affect our workings, the workings that we normally do. It will actually affect it. Now, when you are the workings under SOFP is up to 5, as I taught you. In this case, because of the associate, it will have to move to 6. All right. And the 6th one is what you see here. Also, your workings 5 normally in your SOFP is now going to change because you have to bring in the associate. Okay. So that is what happens. So take note of that. Now, because of that, let me just go ahead and give you the working 6. And like I said, the workings 5 to what? It will change. Okay. The workings 5 to change. The workings for the associates in terms of the Conso balance sheet, all right, will change. And also, if you are also doing P&L with associates, you will have to do the same thing that you always do for the NCI, all right, the subsidiary, the NCI. In the SOFP, I gave it to you. In the P&L, I gave it to you. It will also change here, all right. That workings 4, you have to do 1, and that will be the only working that you do for the associate when you are doing P&L. All right, so that is that. So because of these, what I'm going to do is now open a fresh page here. Now, before I do that, may I talk about some adjustments that you may see, all right, so that we can move straight into the format that I'm about giving you. That is all I'm doing on this. One thing that you have to take note, so let's talk about the adjustment. And here our focus is on who? The associate. Okay, the associate. Number one is that if there is any dividend that is received from associate by virtue of your investment in there, what do? You will have to remove it. So you have to remove it, you remember, from the investment of the parent in the P&L. So dividends received from associates. Just as when you receive dividend from the subsidiary, you remove it. Here too, you remove it. So deduct what? From investment income in P&L. That's all. That is all you need to do. Okay. Yeah. Number two, what I want to bring to your attention is that transaction between the balances, like the way you had the transaction between the associate and the balancing between the parent company and the associate, like the way you see it there in the subsidiary. Here, the balances between the associate and the parent company are not eliminated from the consolidated financial statement because the associate is not part of the group. It's not part of it. It's just an investment. Okay. So I said what? Transactions and what? Balances between parents and associates are not removed. Why? Because the associate is not part of the group. Okay. The parent doesn't actually own it. He just has significant influence. So any balances, any transaction between them are not what? Eliminated. Note that. Note that. All right. However, you see, we said the balances and the transaction. However, the PAPs are eliminated because those are profits. PAPs are what? Eliminated. They are removed. All right. So that is that. That is that. And so therefore, what we say is that if the associate sells to the parent, okay, what are you going to do with the PAP? If the associate sells to the parent, here we are not concerned about who sold to who. All right, we are not concerned. So if associates, the only thing that happens is that if associates sells to the parent, all right, what are we going to do? We are going to debit the inventory. Oh, sorry, the retained earnings, group retained earnings, that is the associate. And we are going to credit what? The inventory. So that is what we do. All right. That is what we do. So note this very, very carefully. However, if the parent is the one that sold to the associate, i.e., the associate is the one that paid it. Okay. So what is going to happen is that if P sells to A. Okay, so what is going to happen is that in that case, we are going to debit our cost of sales or retained earnings. Here, we don't do retained earnings for the associate. Main focus will now be what? Cost of sales, which in turn affects the retained earnings in the what? The SOFP. All right. So that is what happens. The credit, however, is what? The credit investment in the associate. And that one is an SOFP, right? The statement of financial position. So that is what happens. So these are the only things that probably you will encounter. All right. That said, let's look at when you are doing Conso SOFP and there is an associate, and when you are doing what? Conso profit and loss and there is an associate. So let's just look at the formats and end the class. All we need to do is further take up a question and be solving them. All right. So in Conso SOFP with associates, all that you do is to adjust your workings 5, like I said, and you also have to adjust what? Your working 6. Okay, but in Conso, P&L with associates, you have to introduce in what? Workings 5, which will also be like just like you do for the subsidiary, that NCI portion, that when you are the adjusted profit, when you get, you share when you do your P&L. The same thing that we are going to do here. So in our group reserve in the P&L, in the statement of financial position, what do we always go through to do? So let's say we all know that the parents retain earnings come, right? So that is what you get, and it's always the 100%. And what do you do immediately after? You always bring in what? CI share of post-acquisition. So because there is an associate, you have to tag this one subsidiary. And also bring the CI share of post-acquisition of the associates. So that is that. That is that. How do you get the post-acquisition? So you are going to apply your CI percentage by what? The retained earnings of the associate at reporting date minus the retained earnings at acquisition. Don't forget that if it is prorated in months, you have to divide, okay? So don't forget that. If it is prorated in months, you have to also prorate it, okay? So that is that. So once you compute it, you can now get your CI share in the associate. What do we do again? I think we also add what? Negative goodwill. You will see that if the bargain is if there is a goodwill is negative, you bring it here. All right. It means that you bargain well. Also, remember, if you have a contingent liability, which is a loan note, and the fair value of the loan note, let's say at the time that you were doing the acquisition, the loan note's fair value was say 15,000. All right. And at the time that you have to pay, the fair value is now 10,000. It means that you had a liability of 15,000 at the beginning. At the end, you realize that it's 10,000. Then it means that the 5,000 in between is also what? A gain, all right? It's also a gain, all right? So just know that. So, or gain on what? Contingent liability. And here, my reference is what? The notes, the loan notes. Okay, so you add them, all right? What are the things that you less? You always less what? First thing that you less is what? Goodwill impairment, if any. Impairment. And these things are coming from your working stray. Goodwill impairment is coming from working stray. And don't forget, it is what? The CI share. All right, so you take it off. Okay, we also less what? PAPs. All right, we also less PAPs. We also less PAPs. The PAPs, remember we have two types. So PAPs inventory, okay, in the parent with subsidiary, you have to less it. All right. Then we have PAP what? Inventory again. And this PAP is when what? P sells to S. Don't forget. And we have PAP inventory. This is one is associate. But here, it doesn't matter who sold to who, right? Regardless of whoever sold to who. It's still PAP. You take it off. Okay. Then, what do you know again? We have PAP PPE transfer. Yes, don't forget that. So that one too, if the transfer is done by who? You have the subsidiary. If P sells to S, sorry, P to S, you less it. But don't forget, if S sells to P, it is positive here. Don't forget that. S to P, you have a positive figure here. Don't forget that. Please don't forget that. All right. That is that. Hardly do you get PAPs in PPE transfer with the associate. If there is whatever it is with the associate, then regardless of whether it's an inventory or PPE, it's still what? Like this. So you don't need to stress yourself. The last thing that we need to do is what? The unwinding. Finance cost. So all those things that you know, and now the only introduction we brought in here is what? CI share of post app, which also is in working 6, and I've shown you how you get that. Then what you also see is this one. Goodwill impairment, if there is such also in the associate, drop it here. All right, drop it here. That one, it doesn't matter, associate or sub, drop it here. Okay, so, and here too, we brought in what? PAPs. Just take note of that. Okay, so that is how you get your retained earnings to your SOFP. All right, it's as simple as that. It's as simple as that. Okay, as simple as that. The working 6, in case you have to do SOFP, the working 6 is simple. Here, what we are determining is what? The investment in the associates. Okay, and it's just like the way we do when we are doing MCI. What do? You bring in the purchase consideration, which is the cost of your investment. All right, then what do? P share of what? Post acquisition reserve, and that is the one here. All right. So you drop it in there. Okay. If it is a loss, please subtract. Don't forget that. Then you bring in the P&L items, P share or CI share of what? Impairment loss. We are talking about the ones in the associate. Don't forget that. You take it off. All right. Then the unrealized profit, CI share of what? PAPs, especially P being what? The seller. P selling to S. All right. Or A here. Let me use A. P selling to A. You take it off. Okay. What do you do again? If there is any CI share of what? Excess depreciation, fair value adjustment in the associate, please. In the associate. On fair value, any fair value adjustments. All right. In the associate, you less. That's all. You need all these three things. Then you get your investment in associate. It's not that difficult. That's all. And the investment in associate will replace investment that is in the balance. So, I mean, that is all. That is all. In case you are doing Conso P&L, what you need to do is that you need to have a workings for the associate. Do you remember how we do it? We bring in what? P share of associate profit, just as we say P share of subsidiary profit. And please remember, if you have to apportion them, time apportionment. So you drop it, all right? Then you less what? The current year's impairment loss. The same thing you do for the subsidiary. Current year's impairment loss. You take it off, all right? Now, the PAPs too. PAPs, okay? And we have PAPs inventory. So here, if P sells to S, okay, you know, whether S sells to P or P sells to S, that one you drop it here. But here we are talking about who? P share of the unrealized profit. Okay, so that is what we mean. We are talking about the P share, parent share of, or CI share of what? The PAPs. The PAPs. And sorry, let me retract my first statement. Here we are talking about if the associate is the seller. Don't forget, we are here. I thought we were still here. We are in P&L, and our focus is on what? The associate. So everything associate. All right. P share of the PAP in the associate. If the associate is the seller. All right. Remember, that is what you go through. Okay. Then we have what? Excess depreciation. Parent share of excess depreciation. The ones that you see here. On fair value adjustment. So that one you take it. Okay, easy peasy. That's done. All right. So this is what you just need to go through. You will slot it in your what? In your SOFP. When you get this adjustment, adjusted profit, that is the share of the associates. All right. So that is that. Within the consolidated, if there is any OCI, the group should present its share of the associates, all right, in other comprehensive income, if it is applicable, if there is any OCI. All right, so that is that. So I'm leaving this thing on the board for a while and go through and monitor it, because the next time we meet, we are going to be solving problems. All right, we are going to be solving for you down. All right, I believe by now you have what you want. You viewed it. So this part is SOFP. This part is, but here it's not like you are going to strike the CI percent and I mean go and add it to your console P&L just as we do the attribution. Remember, this is not part of the consolidation. All right, you don't consolidate uh like the way we attribute it. So you are not going to do any percentage. This is just the P&L for the associates. All right. So, but you don't actually do any attribution to it. You just work it out. All right. If you are what required to do so. All right, just as here you do, feel like you should also do for this place. All right, but you don't do any attribution, strike percentage, and when you do your P&L, you say attribution, owners of parents, then no, that one is done just for the sub because the subsidiary is part of the group. Here, this one is not part. All right. So thank you. Have a great day. When we meet again, it's all about problems solving. All right. So now you are so complete. You can take any question and solve. You are so complete. So that is what we'll be doing anytime we will meet. Okay. All right. So what are we left to do in the discourse? The next time we will talk about ratios and interpretation and probably work a cash flow. All right. You are ready for the exams. All right. Bye-bye.